Hello, this is Francisco, and I welcome you to this presentation about volatility expansion strategy. Let's begin. Statistics is the part of mathematics that deals with the accumulated information about a dataset. Normally, the dataset cannot be described by an analytics formula because it comes from a random process. Two main measures we use routinely: the center of our observations and the variability of the points in our dataset from that center. There are several ways to compute that center. The most common is what we call the mean. The mean is the average of the dataset. It is computed by adding all elements of a set and divided by the number of elements. The variability of the dataset may be calculated using different methods. Two main ways is used in financial markets: the range and the variance. Range is the easiest way to measure variability. The range is the difference between the highest and lowest points of a dataset. On financial data, usually a variant of the range is calculated. For this strategy, we are going to use the range as a measure of volatility. Concretely, we are going to use the average true range indicator over a very short period of time to spot volatility sudden changes. These are the rules for the volatility expansion strategy. Long entries. Set a buy-stop order at open plus the average true range of the length parameter multiplied by the non-ranges parameter next bar. Short entries. Set a stop sell short order at open minus the average true range of the length parameter multiplied by the non-ranges parameter next bar. So we have two parameters, length and non-ranges. Length defines the number of elements to average in the average true range, and non-ranges is a multiplier of the average true range to optimize the point of the stop order. The standard parameters are length 4 bars, non-ranges 1.5. Let's see how it performs. As we can observe, the actual ROC curve is very good, showing continuously growing equity balance, and drawdowns are not that deep. We are confirming that trading following the direction of a sudden change in volatility is a terrific method to trade with the trend. We see also that the total trade analysis for single contract trades shows a very good 2-to-1 reward to risk ratio, and the percent profitables are 35%. Let's see how parameters behave. Here we show the length parameters for longs and shorts. As we observe in the figure, there are two areas, A and B, where to locate the best parameters for this strategy. The surface is smooth, thus guaranteeing that the shift in market conditions won't harm too much the strategy. For the sake of symmetry, we will choose the region A, thus the long ATR length will be 10 and the short ATR length will be about 13. This figure shows the map for the non-ranges that weights the ATR value and sets the distance of the stop order from the current open. The surface is also very smooth, therefore we can be relatively sure that setting the non-ranges value to 1.3 in both cases will get good results. The new equity curve has improved a lot, especially in the drawdown aspect and in the overall results as well. This kind of strategy incorporates its stops because it's a reversal system. Therefore, there is no need for further stops or targets. On the total analysis table, we observe that the percent winners are close to 39%, while the risk to reward ratio, represented by the ratio average win to average loss, is 1.9. Also, we see that the average trade is 28.5 euros, which is the money expected to gain on every trade. That shows the robustness of the edge. On this shuffle Monte Carlo analysis, all trades are exactly the same on all paths. The only difference is that the shuffling changes its order. This allows us to observe other possible histories of the equity curve. The original trajectory is the green one, while the blue history experienced the lowest risk, with less than 5% drawdown, and the brown one was the one with the largest percent drawdown of the set. 33%. The shuffle graph of this strategy is quite good because the width of the smoke cloud is relatively thin, indicating a good probability of small drawdowns. The total trade analysis graph shows that the profits after 14 years were between 180,000 and 230,000 euros using single lot trade. We see from the previous total trade analysis table that the system made 7,149 trades in 14 years, or about 42 trades monthly, therefore producing about 1,300 euros per month on a single lot trade. Max drawdown analysis shows that the most likely figure is between 11,000 euro and 15,000 euro. This is from 5 to 10% drawdown on a single lot trade, which is quite good. The max losing streak analysis shows that it could go from 15 up to 18 losing streaks in a row, although there is a small chance that this figure could go up to 22. Let's see how we protected against a 22 losing streak. If we want to protect our equity from a 33% drawdown, that is 1/3 of our total equity, we divide 33 by 22, and this is 1.5%. So that 1.5% is the maximum risk per trade allowed if we want to avoid 33% drawdowns. This means we cannot trade with more than 15 euros risk for every 1,000 euro on our trading balance. So, for instance, if we have 10,000 euro in our account and the risk on a trade is 50 euro, we cannot trade more than 3 lots. This is not meant to teach math, therefore we'll keep math to a minimum needed to understand the concept of diversification. To understand the power of diversification, we assume that we are able to find a basket of totally uncorrelated assets. In that case, the total risk of the basket is computed by the formula above. Total risk squared is the sum of the weights on every asset multiplied by its risk squared. For the special case where weights and risk are identical, total risk squared is equal to n, the number of assets in our basket, multiplied by r squared, the risk in every asset. For a basket of 5 assets, this means total risk is the square root of 5 multiplied by the individual risk r, or total risk is equal to 2.23 multiplied by individual risk r. Therefore, a basket of 5 assets combined have less than 50% the risk of a 5R position in one asset. Therefore, it is wise to have a basket of uncorrelated assets to reduce risk. Let's see how to trade using volatility expansions. Well, the idea is to put stop orders at the open plus some measure of volatility multiplier. For example, the idea is, in this case, the open is here, and we should add some measure of volatility, maybe around here or something like that. And this is a stop order. This is a stop order. So if the candle starts here and continue going up, it catches our order and maybe continue or not. For example, in this case, around this place, volatility has shrunk. You see? So if the order, the volatility is around the average to range is nearing this level, so we add the average to range plus a value 1.5 or something like that, 1.3, and we take the order here and goes up and then closes below our trading, below our stop loss, and we get out of the trade. In this case, it takes our stop and continue going until some measure of volatility takes us out. And it goes with us this way. And then another measure of volatility may be around here, because volatility has growth here. Maybe here it takes our trade to the upside. That's the way it acts. But it's very difficult to do this kind of trade without any help. So I found a way for you to position correctly in the direction of the main trend. And well, we are visiting meql5.com because here we will find a nice indicator to help us with the volatility expansion strategy. We type volatility, and the first one, volatility ratio, is the one we look for. It is free, so we download it, and we install it automatically in our MetaTrader 4, allowing it, and here we are. Okay, this is the sound when everything is fine, so we insert it using custom indicator volatility ratio, and here we will type a 10 period because we want a 10 period. So this is it. Not always is right, but you will have nice arrows to point in the right direction, hopefully. And it works as we said. Here he is commanding to buy, and this time is also commanding to buy. Okay, this is not a nice area to use, but when we reach the trending situation, we get nice trades. Also here, this is a nice trade in the short direction, another trade in the short direction, and a trade in the long direction. So you see that it might help you achieve your results pointing in the right direction of the trend. So yes, this is how to use a volatility indicator to trade the volatility expansion strategy. This is everything for all, and till next time.